to learn accounting, the concept of debits and credits is one of the most important to understand. But many struggle with it. And for me, it was the same in the beginning because it's not something that's completely explainable with logic. But I managed to understand it, and by the end of the video, so will you. In accounting, debits and credits always go together. Every transaction will have debits and credits, and at least two accounts will be affected. So remember, one transaction affects two accounts. If one account is debited, then the other one must be credited. Just think of it like a bank transfer. When you send someone money, it comes out of your bank account and it goes into their account. In accounting, instead of these piggy banks, we use T accounts. Every account has its own T. The left side of the T is where the debits go. Credits go on the right side. That's already the first main rule you have to remember. Debit and credit do not mean plus or minus. It literally just means debit goes to the left side of a T account and credit goes to the right side of a T account. Debit means left, credit means right. That's rule number one. The second important rule is that for every transaction, the total amount of debits must equal the total amount of credits. If you debit an account for 100, you must credit another one with 100. There can be more than two accounts involved in a transaction, but never less than two. That's rule number two. Now, the third rule usually creates a lot of confusion, but you'll be fine because I have a secret weapon for you. More on that later. Before we dive right in, let's do something else first that we'll need in the process. And that's to figure out the balance in a T account. The balance is basically the total of an account. So let's say we have these two accounts visualized as T's. Then we record some transaction to them. First, account number 1 gets a debit of 500, and account number 2 gets a credit of 500. For the second transaction, account number 2 gets a debit of 100, and account number 1 gets a credit of 100. With that, we successfully applied the first two rules of debit and credit. We put debits on the left side of the accounts, credits on the right side. And for each transaction, the total of debit and credit was the same. So far, so good. Now to calculate the balance or total for the accounts, we add up the amounts on the debit and credit side for each account separately. Account number 1 has 500 on the debit side and 100 on the credit side. We deduct the smaller sum of credits from the bigger total of debits, which gives us 400. In accounting, we call this a debit balance of 400. For account number 2, it's the opposite. It has a credit total of 500 and total debits are 100. Again, we deduct the smaller one from the bigger one. Account number 2 has a credit balance of 400. Here comes the confusing part. Let's say we have another transaction that adds another debit of 50 to account number 1 and one more transaction with a debit of 100 going to account number 2. Let's just say the credits for these transactions go to different accounts. We don't need to worry about these for now. What would happen is that the balance of account number 1 would increase while the total of account number 2 decreases. Both received a debit, but one account increases while the other one decreases. They are behaving differently. And that's rule number 3. It depends on the account if a debit or a credit increases the balance or if it decreases it. And that's really the secret to understanding debit and credit. Like we saw in our example, the balance of account number 1 increases with the debit while the balance of account number 2 decreases. You may ask, but how do you know which one it is? Fortunately, there are only two groups to remember. The first group includes assets. That's the resources the company owns and uses, like buildings, machines, equipment, and so on. Dividends. That's when the company distributes its profit and cash to the owners. And expenses. That's money we pay for goods or services the business purchased. All accounts in this group are debits, which means that their balance will usually be a debit. Therefore, the total of these accounts will increase when they get another debit and will decrease when they get another credit. So account number 1 in our previous example would be in this group. The second group includes liabilities, which is money we still owe to others, like to the bank, to suppliers, or to the IRS. Owner's equity, that's the money the owners of the company put into the business. And revenue, that's the money we receive for sales to our customers. All accounts in this group are credits, which means that their balance will usually be a credit. Therefore, the total of these accounts will increase when they get another credit and will decrease when they get another debit. So account number 2 in our previous example would be in this group. And that's rule number 3. It's really important that you memorize this, because to record any transaction, you have to answer 2 questions. Which accounts are affected? Did accounts go up or down? We will cover this in more detail in the next video, but just so you know that in order to answer question number 2, you need to understand if an account is a debit or a credit account. If you have trouble remembering this, just think of a Dexler. Accountants don't expect low earning rates. Assets, dividends, expenses, liabilities, equity, and revenue. ADEX are debits. The balance of these accounts increases with debits and decreases with credits. So let's take cash for example. Cash is an asset, so it resides on the debit side of our equation. When you take money out of your account to pay for something, you reduce your cash balance. And remember our rule, the balance on the debit side increases with debit and decreases with credit. So do we debit or credit the cash account? We credit it because we reduce it. Lower our credits, the balance of these accounts increases with credits and decreases with debits. Take a loan, for example, which is a liability. When you take out a higher loan, you credit the loan account. When you pay back a loan, what do? You debit the loan account, which will reduce its balance. So that's really all there is to it. All you have to remember is accountants don't expect low earning rates. A Dexler. Assets, dividends, expenses, liabilities, equity, and revenue. This will help you determine debit and credit accounts. Just practice it and it's eventually going to become second nature to you. Hit that bell so you don't miss out when I put out new videos here. Thank you for watching. See you